Hello and welcome to the Global View on this Tuesday. Well, sales of new homes in the US fell more than expected in October, with higher mortgage rates making housing more unaffordable. New home sales dropping 5.6% to a seasonally adjusted annual rate of 679,000 units. That was last month. The rate on the popular 30-year fixed rate mortgage has risen to almost 7.8%, the highest level since, in 23 years, in fact. Now, the weak housing data pushed US Treasury yields lower, with the 10-year down 5 basis points to 4.43% and the 2-year falling to 4.92%. And the US dollar slid against most major currencies and is heading for its biggest monthly drop in a year, weighed down by expectations that the Fed could begin cutting interest rates by the first half of next year. The Aussie dollar has risen above 66 US cents. And the euro was little changed after ECB President Christine Lagarde said that Eurozone inflation pressures are easing, but wage growth is still strong, saying this is not the time to start declaring victory. We need to remain attentive to the different forces affecting inflation and firmly focused on our mandate of price stability. All right, well, for more on what is moving macro and also the markets, with an emphasis there on Europe, I caught up with Mathieu Savary from BCA Research.
Well, when it comes to the ECB, they are acknowledging that they don't really need to increase interest rates further, as it's true, inflationary pressures have gone down tremendously. Headline inflation has gone from well above 10% to roughly 3%. Core CPI has turned the corner. Monetary policy is working. But at the same time, the ECB is very worried that wage pressures haven't been fully tamed in the Eurozone. So when we look at various indicators, it's probably a slightly misplaced fear, because the leading indicators of employment point toward a deceleration of wage growth and employment growth. In fact, it points to a contraction in employment. So for the time being, we know that the ECB remained very worried for that. It increases the risk of a policy mistake to keep monetary policy tight for too long, but it is very clear that they are unlikely to cut rate anytime soon, and we continue to expect the first rate hike to take place toward the summer. Now, when it comes to growth, we got a few positive signs last week, specifically the German PMIs in particular improved, and this very much fits our view that the global economy will enter a bit of a mini cycle where things will look a little bit better for the next few months, mostly driven by an inventory cycle. But ultimately, monetary policy is very tight. The labor market has begun to deteriorate at the margin, and the US economy is also likely to experience a recession next year, which means that European export will weaken. So in our opinion, the odds of a recession in the Eurozone starting the middle of 2024 remains elevated.
So, Mathieu, given that economic outlook then, what is your expectation just as far as those earnings are concerned for those European stocks?
So our view is that earnings have actually downside next year in the Eurozone. There's a few reasons for that, but the main one is that nominal GDP growth, which drive earnings growth, in both the Eurozone and the US are decelerating. They're decelerating because inflation is slowing down, and we do expect a recession next year. So this means that we do see a worsening of the earnings outlook in Europe. And to add insult to injury, wage growth will peak, but we are well above 4% right now, which is above the level of inflation in the Eurozone, which implies that profit margins, not just revenue growth, have downside from here. So we do expect earnings to decline, which we believe will lead at some point in 2024, probably toward the end of the first quarter, to a significant bear market in European equities, probably down 20-25%.
Mathieu, I'm interested to get your view in relation to what we've seen in the States, of course. The outperformance, particularly the S&P and NASDAQ, largely driven by the performance of the so-called Magnificent Seven. I gather there's also an equivalent there in Europe with the Magic Eight. What are you seeing?
Yeah, so we were very interested to see that if you compare the performance of the S&P 500 to the Euro Stoxx 50 and you remove the Magnificent Seven, it turns out that the Euro Stock and the S&P 500 moved in line with each other. There's no significant difference. So we started to look, do we see the same phenomenon in Europe, where a few stocks really explain all the gain of the index? And yes, there are 8 stocks that explain nearly all the positive return of the Euro Stoxx 50 since 2010. And those stocks are they are a broad-based set of industries, industrials, consumer stocks, tech, healthcare, chemicals, and they share one common attribute, which is that they are high-quality stocks. So they've generated above average earning growth. They have very strong return on equities. Their interest coverage ratio looks better than for the rest of the index, and so do their debt to equity. So they've moved in line with the quality factor globally, which helps explain why in some ways they look very similar to the Magnificent Seven.
So Mathieu, if it transpires that recession takes place next year, at least globally, how is that likely to affect those magic 8?
So those magic 8 are very sensitive to global export growth and to essentially foreign sales. That's what has allowed them to offer this magic, if you will. So structurally, it's a very positive attribute within European indices because it means that they are less exposed to the tepid demand that Europe offers domestically and more exposed to the global industry, the global business cycle. Now, that being said, the issue entering a recession for those stocks is twofold. First of all, because they're more sensitive to global export and European exports to the US and China in particular, we know that in times of recession, export growth tends to suffer more than domestic demand. So that could create a bit of a headwind for the stocks. But I think the main headwind is, in fact, in the near term, their strong correlation to the growth factors when you think about style investment. And the reason is that growth stocks and quality stocks globally have attracted most of the flows in the last 10 years, but also since the pandemic, which means that if we do get a recession that causes a bit of a liquidation event in stocks, the most owned stocks are the ones that are likely to experience the most pronounced liquidation pressures. So this means that we anticipate those stocks, those 8 stocks, to underperform the overall market in the context of a recession. But that, in our opinion, creates a wonderful buying opportunities for investors as their quality attribute will remain in place despite the recession.
Yeah, that was my next question. So if you're seeing perhaps weakness ahead, at least in the short to medium term, then you're saying you should remain patient when you look at those 8 stocks, because if they fall to that point, it does provide that buying opportunity.
Yeah, absolutely. This is, to me, really the key message, which is that when we get that sell-off in stocks, probably, as I've mentioned earlier, toward the end of the first quarter, toward the middle of the year, up to the middle of the year, those stocks, because of their high momentum and they correlate also strongly with the momentum factor, are likely to suffer in the process. But it's very much a blip in their long-term story, and I'd be looking to buy those stocks in the second half of 2024.
Mathieu Savary from BCA Research. All right, just to double check of where we're likely to get going. We did see those global equity markets come off, bit of profit taking we saw overnight. SPY futures indicating we will begin higher. Mind you, that's the point we were at yesterday, and then of course we did suffer some significant falls across the market. Stay with us, the open just a couple of minutes away.